right, so we're looking at an earned income, okay, an earned income, or sometimes it's called an earned revenue, or sometimes it's called prepaid income. All right, this is when we receive money in advance from for our goods and services that we give to our customers. All right, we receive money in advance. Now, this money which we receive in advance is a liability to us, right? Because if something had to happen, then we're going to owe our customers that money which they have given us. All right. So this is a liability. Okay. So now we're going to look at the year-ended adjustments for prepaid income. All right. So there are two methods that we're going to use. There's the liability method and there's the income method. The liability method, we're focusing on the amount we have earned, right? On the amount that we have earned at the end of the year, okay? And then the income method, we're going to be focusing on the amount that we haven't yet earned, okay? So here's our first example. On December 1st, 2021, X Limited paid rent in advance for 3 months, okay, which is 60,000. Oh, put the word advance twice, but they've paid for 3 months in advance, okay, and that's 60,000 on the 1st of December, right? Now we have to record the year ended adjustment for December 31st, 2021. All right. So basically from December 1st to 31st, that the timeline is 1 month. We have used up 1 month. Okay. So first let's find out our monthly charge. All right. So they paid for 3 months. So we're going to divide 60,000 by 3, right? That is going to give us 20,000 kwacha. So that's how much we are receiving as rent income. All right. 20,000 kwacha per month. That's the monthly charge. All right. All right. So let's find out how much has been used up and how much hasn't been used up, or how much has been earned and what hasn't been earned. All right. So from 1st December to 31st December. Okay, that's 1 month times the monthly charge, 20,000. Okay, we get 20,000 kwacha that has been earned, right? So 60,000 minus 20,000, that's 40,000. So we're going to say 20,000 has been earned, right? And then 40,000 not yet earned, not yet earned. Now we're going to use the liability method where we're focusing on the amount earned. All right, so we start with the liability method. Let's put here liability method. Okay, so we're going to make the journal entry for the 1st of December. All right, for the 1st of December. All right, this guy is paid the rent, so we're going to debit cash, right? Because we received that money, and cash is an asset. An increase in an asset is debited. All right. Then we're going to credit an earned revenue. Okay. An earned income or prepaid income. Okay. Maybe let me just call it prepaid income. That sounds much better. So yeah, we credit prepaid income. Okay. And this is rent. All right. This is the rent. We're going to credit prepaid income 60,000. right? Remember, this is income. This is an income account. Income accounts increase with credit. All right. Okay. Now, on the 31st of December, and on the 31st of December, on the 31st December, right, we are going to credit rent income. Okay, we credit rent income, right? This is how much has been earned. This is our rent income, all right? This is how much has been earned. So we credit rent income because remember, rent income or revenue increases with credit, all right? So we're going to credit our rent income, and then we're going to debit, all right? We're going to debit our prepaid income, okay? Our liability is decreasing, so we debit it, all right? Liability is decreasing, so we're going to debit 20,000, all right? As I said, in the liability method, we're focusing on how much we have earned, and this rent income is how much we have earned. In other textbooks, you find this as rent revenue, okay, or rent income or rent revenue, whichever. All right, and in other books, instead of prepaid income, you find unearned income, right? They would use unearned income, which is the rent, but one and the same things. All right, so now let's look at our T accounts. Right? So we have cash, and we'll have the prepaid income. Okay, prepaid income. Okay, let me put slash unearned income. All right. So we're going to debit cash 60,000. Okay. And we credit prepaid income 60,000. Remember, prepaid income is a liability, and an increase in liability is credited. Okay, it is credited. This is a liability. All right, it is a liability. All right, then at the year end, all right, we have our rent income account. Okay, so this rent income account, this is a revenue account. Okay, this is a revenue account. And so we're going to credit it 20,000. Remember, an increase in revenue is credited, right? Increase in revenue is credited. Then we'll debit the prepaid income, okay? Because a decrease in a liability is debited, all right? A decrease in a liability is debited, all right? So we're saying our liability has decreased by 20,000, okay? So now let's find the balance, okay? Okay, so I'm going to put 6,000, 60,000 here, and 60,000 here. Okay. So balance carried down. This is the amount which hasn't been used up. All right. What answer we're getting here? This is the amount that hasn't yet been earned. All right. So equals 60,000 minus 20,000. All right. 40,000, right? As we stated earlier, this is the amount that hasn't been earned. Okay, so here, this is the amount that hasn't been earned. Okay, and we'll bring here our balance brought down 40,000. So meaning our liability has decreased to 40,000. So this, you're going to find this liability in your balance sheet. All right. Remember, liability accounts, find them in your balance sheet. Right. Then this rent revenue, okay, we are going to find it in our statement of profit or loss. All right. After you find your gross profit, okay, after you find your gross profit, then any other forms of income that are added, you add that to your gross profit. That's if we say we are, let's say we're a business and on the side we also rent out buildings, okay? We rent out buildings. So that's an extra form of income, an extra way of how we earn our income. All right. So on our gross profit, we're going to add this rent income to the gross profit on the profit or loss statement. All right. So we'll just close this account. We're going to debit it, this account, debit it, right? And we'll credit the profit or loss account, right?